Welcome to Griffonomics.
Glad to be here for this one.
So right now, massive AI data centers are being built basically all across the country.
Yeah, they're popping up everywhere.
Everywhere, right. And the modern chips powering them, the GPUs, they run so incredibly hot that traditional server rooms would literally just melt without advanced direct-to-chip liquid cooling.
They just cook themselves, yeah.
Exactly. And you might think the biggest winner in that scenario is, some flashy Silicon Valley tech firm.
Right, some software giant.
But actually, the company keeping the AI revolution from bursting into flames, it's a $340 billion plumbing and pipe distributor hiding in plain sight.
It really is the ultimate behind-the-scenes play. I mean, totally unglamorous.
Totally. So today, we are bringing you a special deep dive. Our mission is to unpack this massive market behemoth, Ferguson Enterprises, stock ticker FERG.
FERG, yep.
We've got a huge stack of sources today. We've got their Q1 2026 financial disclosures, proxy statements, and some really deeply forensic strategic analyses.
And we're going to use all of that to decode what the industry calls Ferguson's balanced end market dual engine.
Right, because we're not just, reading numbers off a spreadsheet to you today. We are building a granular strategic roadmap.
Exactly.
We're going to figure out how they're, weaponizing their capital allocation, executing this private equity-style rollout, and navigating a really weird macro environment.
Which is vital to understand because Wall Street consistently mischaracterizes Ferguson.
Oh, completely.
Analysts look at them and they often see basically Home Depot's boring cousin.
Right.
Like a cyclical home improvement retailer that just rises and falls with housing starts and consumer confidence.
Which is just wrong.
It's totally wrong. When you dig into the structural mechanics, you realize they are actually a secular supply chain compounder.
Okay, let's unpack this. When you say secular supply chain compounder, you basically mean they grow consistently over long periods, right?
Yeah.
Regardless of whether the broader economy is booming or busting, simply because they are fundamentally woven into the infrastructure we need to just, survive.
Precisely. And to understand how they achieve that, you really have to look at their position as a mission-critical B2B intermediary.
Right.
They are the ultimate supply chain link, pulling over 1 million unique products across the North American construction market.
I like to visualize their business model as like an hourglass.
Oh, that's a good way to look at it.
Right. So think about the top half of that hourglass.
Yeah.
You have this incredibly wide, highly fragmented universe of 37,000 global suppliers.
Manufacturing every valve, pipe, and fitting imaginable.
Exactly. And then on the bottom half, you have over 1 million active professional tradespeople, commercial builders, municipal governments, all trying to source those parts.
And Ferguson is that narrow pinch point right in the middle.
They're the gatekeepers.
They are. And that pinch point creates immense leverage for them.
But I'm looking at that structure and I'm instantly thinking about vulnerability.
How so?
Well, if you are just the middleman, what happens when one massive supplier decides to hike prices? Or, what if a giant national home builder flexes their muscles and demands a huge discount?
Doesn't the guy in the middle get squeezed?
Yeah, exactly. Don't they get crushed?
It's a completely logical concern. But Ferguson has engineered their contracts to ensure that never happens.
Really? How?
They've established what we call zero concentration boundaries. So on the supplier side, no single manufacturer accounts for more than 5% of their total cost of sales.
Oh, wow.
And on the customer side, it's even more fragmented. No single customer accounts for more than 1% of their total revenue.
Wait. Out of over $7 billion in quarterly sales, not a single customer moves the needle past 1%.
Not one. Because of that extreme fragmentation, neither a supplier nor a buyer has the gravitational pull to dictate terms to them.
So Ferguson basically holds all the pricing power.
They hold all of it. Now, you combine that pricing moat with their end market balance. Their revenue is split right down the middle, roughly 50-50 between residential and non-residential exposures.
Okay.
But the real genius is the project type. 2/3 of their entire revenue relies on repair, maintenance, and improvement. RMI.
Right. Think about your own house for a second. You might decide to delay a massive kitchen remodel because, interest rates are too high.
Sure.
But if your water heater blows out and your basement is filling with water at 2 a.m., you don't care what the Federal Reserve is doing.
No, you're calling a plumber immediately.
Exactly. And that plumber is buying a water heater from Ferguson. That provides a huge structural buffer against a frozen housing market.
That RMI buffer is incredibly resilient. And, tucked inside that buffer, they've actually built a profitability shield using private labels.
Oh, right?
Yeah, they call them their own brands, lines like Signature Hardware and ProFlow.
Right, because house brands always yield significantly higher margins than selling third-party name brands. And the sources point out that these private labels now exceed the 10% threshold of total corporate revenue.
Yeah.
So that gives them an exclusive gross margin shield, which, if I'm reading this right, was a major factor in them hitting a really strong 31.0% overall gross margin in Q1.
That's right. But we need to look at how that 50-50 end market split actually played out in the Q1 2026 financial tables, because there's an extreme divergence happening underneath the hood here.
Yeah, I saw this. Residential revenue actually contracted by 1%.
The housing market is essentially on ice.
Right. Yet their consolidated net sales grew 3.6%, hitting $7.47 billion.
So the obvious question is,
how do you grow the top line by nearly 4% when half of your entire business is shrinking?
you do it through an absolute explosion on the non-residential
How
side.
about down?
While the residential housing market was a drag, Ferguson's commercial and mechanical customer group surged by an astonishing 18%.
Wow.
Yeah, it single-handedly neutralized the residential compression. They are capturing massive market share in these high-ticket institutional complexes.
Wait, hold on, though. The sources attribute this 18% surge primarily to, quote, AI data centers.
Yeah.
I mean, every legacy company on Wall Street is slapping the word AI on their earnings calls right now to get a stock bump.
Oh, absolutely. It's a huge buzzword.
Right. So why should we believe a pipe distributor is actually a legitimate AI play? Like, is this real?
It's totally fair to be skeptical. We've seen a lot of vaporware.
Huh.
But this is the physical, foundational reality of artificial intelligence.
Okay.
Hyperscale AI data centers require unprecedented utility infrastructure. Modern GPUs, the chips actually training these massive AI models, they run incredibly hot.
Right, we mentioned that earlier.
Traditional air cooling in server rooms, it simply cannot handle the thermal load anymore.
The processors would literally just cook themselves.
They would. So the industry is frantically shifting to high-density, direct-to-chip liquid cooling loops.
Ah.
And someone has to supply the mission-critical pipe, valves, and fittings, the PVF, to build those thermal systems.
And that's Ferguson.
That's Ferguson. They're supplying specialized stainless steel and high-density polypropylene, BPR piping systems designed to transfer chilled fluids directly into server racks.
Because if a standard pipe joint leaks onto a $1 billion AI server cluster, I mean, that's a catastrophic financial failure.
Exactly.
The tech hyperscalers are demanding absolute perfection in fluid control, and Ferguson is like the only one with the inventory density to deliver it at scale.
And it doesn't stop at the server rack.
No.
There is a massive knock-on multiplier effect here. To reject all that heat from the liquid cooling loops, these data centers need giant cooling towers.
Right.
Towers that purge and refresh millions of gallons of water every single day.
Wow.
That pulls through an enormous amount of heavy civil infrastructure,
Wow.
water mains, backflow preventers. It directly drove a 5% volume growth in Ferguson's waterworks group.
Plus, I mean, it takes an immense amount of electricity just to pump that water and power those chips.
Which feeds right into their industrial group. Ferguson saw a 10% surge in their industrial segment, largely driven by the need for raw water treatment and combined cycle power generation networks just to feed these data centers.
So the infrastructure demands are compounding across their entire non-residential portfolio.
Exactly.
So these mega projects are providing this massive organic growth engine, but they aren't just riding the wave, right? They are buying the wave.
Very much so.
Ferguson is engineering growth through acquisitions, specifically rolling up the HVAC sector, heating, ventilation, and air conditioning.
Right.
Their HVAC group managed a 1% growth this quarter, which, sounds small until you realize it was up against a really tough 5% comparable from the same time last year.
Yeah, they're playing the long game there. Right after the quarter closed, they finalized the acquisition of Carrier Great Lakes.
Okay, saw that.
This is part of a broader private equity-style capital allocation framework. The climate control sector is highly fragmented, filled with small, mom-and-pop regional distributors.
Yeah.
Ferguson is using its massive balance sheet to roll them up and consolidate the market.
But here's the friction point for me. When you acquire a regional HVAC distributor, you are really just acquiring their local book of
Yeah.
contractors. What stops those newly acquired contractors from just, taking their business down the street and shopping around for cheaper parts from an independent supplier?
It all comes down to their digital moat.
A digital moat.
Yeah. Over 50% of Ferguson's total customer order volume is now executed digitally. When they acquire these contractors, they immediately route them through the Pro Plus app and their enterprise software interfaces.
Okay, I have to push back there. An app is not a moat. I mean, every pizza place and local hardware store has an app.
Right, but it's not just a digital catalog. They are embedding 3D virtual design and construction, or VDC, directly into the contractor's mechanical workflows.
Okay, what does that actually mean on the ground?
Let's say you're a contractor building one of these massive data centers. Ferguson's VDC teams will map out the mechanical rooms in a 3D digital environment before you even break ground.
Oh, wow.
Then they prefabricate the complex pipe spools and mechanical assemblies off-site in their own facilities.
Ah. So they aren't just dropping a pallet of raw steel pipes on a muddy job site and wishing you luck.
Far from it. They deliver the prefabricated assemblies just in time to the site.
That's huge.
In a world where skilled trade labor is incredibly scarce and wildly expensive, this saves the contractor thousands of hours of on-site labor.
Yeah.
It massively compresses the construction timeline.
Yeah, time is money.
And they even integrate project-based billing directly into the contractor's accounting software.
Okay, I see the moat now.
Right. Once a contractor's entire workflow relies on that prefabrication engine, the switching costs become impossibly high. Going to a cheaper independent supplier means losing your entire design and labor-saving infrastructure.
So what does this all mean for the actual bottom line?
Let's look at the numbers.
Because when you look at the Q1 profit bridge, the accounting gets a little murky.
It does.
Their reported GAAP operating profit surged by 20.7% to $612 million.
Yep.
But their adjusted operating profit only rose by 8.4% to $647 million. Why is there a $35 million gap between the reported numbers and the adjusted numbers?
If you audit the non-GAAP reconciliation tables, you can unmask that delta. That $35 million difference comes down to two specific accounting adjustments.
Okay.
The biggest chunk is $33 million in acquired intangible amortization.
Let's define that for the listener because, intangible amortization sounds like a totally made-up corporate tax term.
Right, it's accounting jargon.
When Ferguson buys up those smaller HVAC companies we just talked about, accounting rules force them to write down the value of non-physical things, right? Like customer relationships or brand names over time. That's the amortization. It costs them $33 million on paper, but it doesn't actually cost them a single dollar in real cash out of the bank.
Right.
So adjusted profit ignores that ghost math to show us how much real cash the business actually generated.
That's a perfect way to look at it. And the remaining $2 million of the delta is just a corporate restructuring charge related to the costs of moving their ultimate parent company's domicile to the U.S.
Okay, that explains the $35 million gap, but it doesn't explain the percentages.
Ah, yes.
Why did the GAAP percentage jump a massive 20.7% while the adjusted only grew 8.4%?
To understand that percentage jump, you have to look at another accounting ghost, but from last year.
Okay.
In Q1 of 2025, Ferguson absorbed a massive $51 million business restructuring charge. This was for branch closures and severance pay to streamline their operation.
Right.
That charge heavily depressed last year's reported numbers. Because that charge didn't repeat this year, the year-over-year comparison looks artificially explosive at 20.7%.
Got it. So the 8.4% adjusted growth is the true structural operational reality of the business,
Yeah.
which is still an incredibly resilient result, given that the residential housing market is totally frozen.
Absolutely.
They delivered an 8.7% adjusted operating margin and that 31.0% gross margin. But when you look at the physics of Ferguson's seasonality, there might be some margin pressure on the horizon, right?
There is, and it's simply the nature of their product mix. As they move into the summer billing cycles, their highly seasonal HVAC and waterworks segments will peak in volume.
Because it's construction season.
Exactly. But because those specific segments traditionally carry lower gross margins than the overall corporate average, management fully expects that 31.0% gross margin to tick down a bit in Q2 and Q3 as those lower margin products become a larger share of the total business.
So the margin percentage shrinks slightly, but because the volume of sales is peaking during the summer, the overall profit dollars are still scaling up.
Right.
They are basically taking a slightly smaller slice, but of a much, much larger pie.
Exactly. The business is structurally designed to expand profit dollars, even when the margin mix shifts.
So the U.S. market is this unstoppable engine absorbing all this AI and infrastructure demand. But, an engine that runs that hot can mask parts of the machine that are breaking down.
Sure.
And if you look just across the border to Canada, the gears are definitely grinding.
What's fascinating here is the Canadian decay is completely hidden by the headline numbers.
It really is.
On paper, the Canadian segment reported a 5.5% expansion in net sales, hitting $326 million.
Which on the surface, 5.5% growth sounds perfectly healthy.
It is a complete mirage. If you strip away the inorganic factors, that growth was entirely driven by two things: 5.8% for mergers and acquisitions, and a 4.6% benefit from favorable foreign exchange rates.
Wow.
Masked underneath all of that paper growth is a true organic revenue decline of 0.3%.
So why is the Canadian market contracting organically while the U.S. is booming?
Unlike the U.S., which has this massive infrastructure and AI boom propping up commercial construction, the Canadian regional economy is facing much stiffer headwinds. They just don't have the same mega project pipeline right now to offset the broader housing and commercial real estate slowdown.
And when you pair that stalling top-line revenue with rigid regional labor inflation, because, you still have to pay your warehouse staff and drivers more just to keep up with the cost of living operating costs in Canada spiked to $82 million.
Right.
That collision caused a massive margin drag. It forced Canadian adjusted operating profit to contract by 16.7%, hitting a floor of just $5 million.
That's a huge drop.
But if you were analyzing this $340 billion market, why does a 16.7% localized drop in Canada matter to you?
Honestly, it matters because it had virtually zero impact on the consolidated business.
Not at all.
Canada's $5 million profit is a drop in the bucket compared to the $647 million total adjusted operating profit. The U.S. scale is so incredibly massive that it effortlessly absorbed the Canadian drag without missing a beat. The sheer gravity of the U.S. operations provides an incredible safety net. And, that structural strength is clearly reflected in their balance sheet.
Here's where it gets really interesting. Let's talk about that balance sheet because they are operating at a 1.0x net debt to adjusted EBITDA position.
Yep.
To put that in plain English for everyone listening, for every dollar of core profit they make in a year, they only have $1 of debt. They could practically pay off everything they owe in 12 months.
Which is amazing.
That is the absolute floor of their target leverage ratio. They are swimming in cash, generating $772 million in operating cash flow just in Q1 alone.
Because they have that pristine balance sheet, they're aggressively deploying capital back to shareholders. They've already returned $410 million via dividends and buybacks in the first quarter.
Wow.
But the most significant financial maneuver is the newly approved $2.0 billion share repurchase program.
$2 billion is a massive amount of capital to deploy. How does that practically impact the stock?
Instead of just viewing it as spending cash, think of this buyback like a pizza.
Okay, I like pizza.
In Q1, their diluted share count was 194.8 million shares. That's how many slices the pizza is cut into.
Right.
If we assume a conservative execution price of $240 per share, which aligns with their Q1 average, that $2.0 billion allows Ferguson to buy up and retire roughly 8.33 million shares.
So they're essentially taking 8.33 million slices out of the pizza box and throwing them away.
Exactly.
The overall pizza doesn't get any bigger. The company isn't magically selling more pipes today. But for the shareholders still sitting at the table, their remaining slices just got mathematically larger.
It is a float reduction arbitrage. Against the 194.8 million total base, that is a projected float contraction of roughly 4.2% to 4.3% over the next 12 months.
That's substantial.
By cannibalizing their own float, they are engineering a massive mechanical lift into their forward earnings per share.
Yeah.
It supercharges their baseline operational growth.
So bringing all this together, we set out at the start of this mission to answer one core question. Is Ferguson just a retail value trap heavily exposed to a frozen housing market, or are they a secular supply chain compounder?
If you synthesize all the evidence,
the
financials, the JAP reconciliations, the strategic roll-ups, the verdict leans heavily toward compounder.
I agree.
Wall Street misprices this stock because they get distracted by near-term macro headwind noise and the stagnation in residential repair.
You just look at the housing starts.
Right, but they miss the structural reality. Ferguson's balanced end-market structure protects their downside. Their unmatched logistics density, with 11 regional distribution centers and 1,750 branches, it creates an economic moat that regional independent suppliers simply cannot cross.
No way.
And the sheer velocity, the non-residential megaprojects, the AI data centers, the water infrastructure, the power grid upgrades, it more than justifies a premium valuation. They operate a compounding toll road on critical North American construction infrastructure.
Understanding Ferguson's model helps you look past all that headline retail anxiety. You stop seeing a company that just sells plumbing parts to local home builders, and you start seeing the structural infrastructure plays that are actually keeping the modern economy running.
Yeah.
You see the liquid cooling loops for AI, the industrial water grids, the climate control consolidation.
And looking ahead, it raises a really provocative question about their future evolution.
Oh.
We know Ferguson currently uses predictive AI, specifically a platform called voaa.ai-led0, to help municipal water grids preemptively identify and replace aging pipes before they physically burst.
Oh, that's smart.
They are actively mapping the vulnerability of North America's underground infrastructure.
Okay, I see where you're going with this.
Right. If Ferguson eventually owned this predictive data layer across thousands of municipalities, could they eventually monetize that data as a high-margin software-as-a-service product?
Wow.
We might be watching Ferguson evolve from a physical logistics distributor into a digital infrastructure monopolist.
Risk defined, portfolio protected.